Everyone, welcome to this video. This is Ronica Brown, your tax advisor and CPA. In this video, I want to share with you the impact that the pending tax bill may have on S corporation. So this is if this bill becomes law come this November. This is the proposal and this is the proposed changes that they want to make to S corporation. So anyone, if you're taxed as a S corporation, you will need to listen up so that you can start planning to make changes right now and know how this will impact you. I was speaking to a client last week who called about a capital gains event that her family will have for this year and next year, and she wanted to know what her options were in terms of tax planning. What I got from that conversation is she's also a business owner who is taxed as an S Corp, and she didn't know that there were changes related to the S corporations as well. So I know that online, the capital gains tax changes from this new proposed bill is getting a lot of airtime. It's getting a lot of basically social media posts and so forth. So for those who normally don't have a capital gains event ever or will have a capital gains event in the next few years, they're not really concerned. But when you look deeper in this bill, in the green book they call it, there are other changes to other entities that will affect small businesses, and S corporation is one of them. So my client that I'm speaking about, she did have a true concern about the capital gains taxes, but I also want to share with you the concern about the S corporation that you can start planning for. What's included in this bill for S corporation is basically this. Congress is like, hey S corporation owners, hey business owners who are taxed as S corporations, we know that you have benefited from tax savings over the last few years or since forever, and we know that some of you are also not in compliance with the reasonable compensation requirement for S corporation. We know that you're not paying your fair share of self-employment tax, isn't so? That's why when you say fair share, never get caught down the rabbit hole, regardless of what side you're on, about people not paying their fair share of taxes. Because right now, no matter what size your S corporation is, Congress is deeming you as not paying your fair share of taxes, whether you're making $50,000, $500,000 or $100,000. You are now in that bucket right now because you're taxed as an S corporation. So it's saying, we know that you have not been paying your fair share of taxes since you're an S corporation. And we also know that some of you guys aren't paying yourself a reasonable compensation, and you have not been paying it. And you know what? This S corporation thing is just an administrative burden to the IRS because of all the things that you need to be in compliance with, and they don't want to deal with it anymore. So we are proposing that we are going to also tax your profits, charge self-employment tax on the profits of your business. So let me break this down for you in numbers. Take, for instance, you're an LLC or a partnership, and your business profit is $140,000. So I'm talking profit, bottom line, after all your expenses, all your write-offs, your bottom line number is $140,000. If you're taxed as an LLC or a partnership, that entire $140,000 is subject to self-employment tax. You have to pay self-employment tax on that entire amount, and the self-employment tax rate is 15.3%, and this covers your Social Security and your Medicare taxes. If that same LLC converts and files the election to be taxed as an S corporation, what happens is this $140,000, you don't pay self-employment tax on it at all. So that is the tax savings for S corporation. And right now in this new proposed bill, the new proposal wants to close that tax savings for S corporations because they're saying that, you're not paying your fair share of taxes just because of how the S corporation is taxed. And this is why the S corporation has become so popular in the last few years. I actually did a white paper on this, a blog on this this year as well, that you can also check out. The link is below. But they want to stop this. So if you're an S corporation, it doesn't matter if your profit is under that $140,000, you're going to basically get caught in this increased tax. So what you can start doing right now is to speak with your tax advisor. This bill, we're anticipating, if this particular provision, remember this tax bill is, I don't even know how many pages. It's a big document. So there are different items that may get passed. You know, they may negotiate on the capital gains. Maybe this S Corp thing is not large enough for people on, you know, in Congress and the House to argue and to make changes. So maybe this one may go through. We don't know. So if you talk to your advisor and they're saying, well, you know, it's not law yet, all you want is the education to know what's going on, so that when it comes time for you to pivot or make a change in entity or do something in order to avoid this increased taxes, you will be ready because you already know how it impacts your business. Hope this helps. Thanks for watching.